the 2010 Berkshire annual meeting, you said the one question that you would ask of the Berkshire CEO would be about the distribution of cash to shareholders as the Berkshire cash pile grows larger and larger.
Have you been keeping up with the wild stock market recently? Bill Smead, an investor, has some interesting ideas about where the market might go next. It's like the whole world is betting on them to change the world, but Bill is not convinced. He thinks we're in a bubble, just like the ones that burst in 1929, 1969, and 1999. History repeats itself, he says. Americans now have a record high proportion of their money invested in stocks, which is even higher than the insane tech bubble of 1999 or the peak in 1929 prior to the Great Depression. At the point when everybody climbs into a venture thinking they'll get rich off it, that is generally the pinnacle of an air pocket before everything comes crashing down. If this is the peak, then what, in Bill's opinion, will transpire next? He predicts that the speculative bubble of the 1960s, fueled by unchecked optimism and reckless investing, will finally be cleared out by 3 major bear markets over the next 10 to 15 years, including the current correction, which will restore balance to the market and teach investors valuable lessons about prudent investing. Stocks lost approximately 90% of their value from the peak to the bottom channel during the 1929 and 1974 bear markets, 2 of the worst ever. Bill warns of another devastating bear market and massive investment losses. A discussion about the market turned to the topic of bear markets. Bill noted that the pandemic bear market bounced back quickly in 2020, but he doesn't expect the same luck this time. It is observed that bear markets can be like sales for smart investors, like Warren Buffett buying stocks in 1974. Bill disagreed as he believed that the current situation was distinct and a swift recovery was improbable due to the differing circumstances. However, it wasn't until 1982 that a genuine, enduring bull market got going again. Presently, stock ownership is dominated by passive index funds like Vanguard. Even a huge company like Buffett's Berkshire Hathaway will likely struggle if the S&P 500 index continues to be sold off and liquidated for the next 10 to 15 years. That sounds like a depressingly brutal stretch for stocks. What is making Bill so negative and critical? He cites the government's unprecedented increase in the amount of money printed to combat the COVID pandemic. This tidal wave of money creation dwarfs anything we saw during the Vietnam War's excessive spending. According to Bill, it is preparing the ground for a significant inflationary wave. Looking back to the 1960s, both the best growth investor and the best value investor at the time were deeply concerned about the government's money printing driving rampant inflation. Bill explained. The renowned T. Rowe Price even attempted to profit from it by launching a distinct commodity fund known as the ERA Fund. The majority of politicians and Fed officials won't be able to stomach that. Simply take a gander at monetarily shocking strategies like California's Crazy. The lowest pay permitted by law climbs to $22 per hour. That is not the way in which you stop expansion, but the way you continue to stir it higher. If Bill is so concerned about inflation, then where is he investing his money to try and protect himself from it? It would appear that the energy industry and fossil fuels are his main convictions. As Bill expressed, over the next 10 years, the single best industry for investors will likely be companies that create and supply fossil fuels like oil and natural gas. These customary energy sources really power our economy, and most recent advances like the energy-swallowing server farms are required for simulated intelligence processing. However, environmentalists' political pressure has kept us from investing in the production of fossil fuels for years. This has set the stage for an energy shortage that will continue to drive up the costs of electricity, gas, and oil. Bill excuses options such as sunlight-based, wind, hydro, and atomic power as deficient arrangements. The earthly people are, in a real sense, even attempting to destroy hydro dams, not form more. Additionally, we won't be able to construct enough new nuclear plants. Even though Bill was critical of the bubble in the stock market, the tech craze, and the passive indexing trend, he did acknowledge that value-oriented investors were smart enough to buy beaten-down FAANG megacaps like Netflix, Facebook, and Google at their lows in late 2022 could still make some money as those stocks recovered from their lows. We don't really trust the long-term business models behind companies like Netflix or the targeted ad engines driving the profits of Facebook and Google, Bill stated. Not exactly the information about the future that the buy and hold passive indexing crowd wants to hear. Chart gives off an impression of being, even more, a revisitation of the uneven mainstream sideways stock pickers market that ruled in previous times of high expansion and monetary discomfort like the 1970s. Is the straightforward financial backer simply an old crab who neglects to figure out new advancements? Or does his framework, which includes the dangers of money printing, speculative bubbles, the rise of passive indexing, and a possible shortage of fossil fuels, make a convincing case that we may indeed be headed for a prolonged rough patch that necessitates a significant change in how we invest? Regardless of whether one agrees with all of Bill's figures, his insightful analysis raises crucial questions that investors would be wise to ponder. If valuations keep rising, it prompts the consideration of how long the passive indexing craze of simply buying into the S&P 500 can persist. It also raises concerns about the long-term effects of extensive money printing undertaken during the COVID-19 pandemic to rescue the economy. Additionally, it questions whether there is an underinvestment in future energy sources that will power cutting-edge AI and related technologies. More importantly, Bill's analysis invites contemplation on whether we are truly in the final stages of a speculative bubble that has been brewing for generations and is poised to burst when the next economic shock or shift in sentiment occurs. While the accuracy of Bill's predictions will only become evident over time, being open to and critically evaluating the risks he identifies could help safeguard investment portfolios in the event of a subsequent bear market, whatever form it may take. Here are some extra snare questions and answers connected with Bill Smead's examination. Do you believe that Bill is judging passive index investing too harshly? The problem now is that passive index funds dominate stock ownership, as stated by Bill. Even giants like Berkshire Hathaway will struggle if the S&P 500 continues to be liquidated for 10 to 15 years. Bill argues that too much money is blindly invested with the same well-known stocks and indices, leading to systemic risk. On the off chance that valuations stay incredibly high and there is a delayed bear market, steady selling strain from financial backers escaping detached assets could exacerbate slumps. Does Bill make a fair examination, or is the latent contributing still a sensible methodology? The absolute best industry over the following 10 years will make non-renewable energy sources like oil and flammable gas. Under political pressure, we have suppressed this investment for years. However, the demand for AI computing will be absurd. Given all of this attention being paid to climate change and the push for renewable energy, Bill's recommendation of oil and gas stocks seems counterintuitive. However, Bill believes that fossil fuels will be required to power AI and data centers in the future. He believes that we have over-invested in the production of fossil fuels, resulting in a supply crunch. Is Bill being overly pessimistic regarding the Fed's capacity to regulate inflation? To get inflation below 3% would require recession-level rate hikes we haven't seen since the early 1980s when I was selling 18% T-bills, states Bill in support of his argument. That simply won't sit well with the politicians. Bill seems to be convinced that the Feds will give in and lose its composure before bringing inflation back down to low levels, given the rise in energy prices and states like California's push for inflationary rate policies. Bill Smead's analysis of the economy, markets, and key investment themes like energy and inflation over the next decade is thought-provoking, even if one doesn't fully align with his views. A central aspect of his perspective seems to be a deep caution towards the Federal Reserve's willingness to endure the level of economic pain necessary to truly tame inflation. While the Federal Reserve has a range of tools at its disposal, from raising interest rates to tightening monetary policy, Smead appears to question whether policymakers have the fortitude to follow through on the aggressive measures required to rein in stubbornly high inflation. Ultimately, while Smead's analysis presents a sobering view, it underscores the importance of remaining vigilant and adaptable in the face of changing economic conditions. That's a wrap, guys. If you found this video insightful, hit the like button and subscribe to our channel for more investment insights. Don't forget to turn on notifications so you never miss an update. Stay tuned for our next video.